Hi everyone, welcome to today's webinar. Sorry we're running a few minutes late, we had some technical difficulties, but thank you for joining us for Reaching Your College Savings Goals with a 529 Plan. Today's webinar is brought to you by Upromise. Upromise is a smart way to save for college every day by shopping online, going out to eat, booking travel, and more. It's free to join and simple to use, so you can learn more at upromise.com.
Here, Katie, actually, we lost sight of your screen here for a second.
Okay. Okay, there we go. So we'll start out by talking how to save for college and actually education. So today we'll cover the different ways you can save for college or private K through 12 school, why we think a 529 plan is the best way to save for college. Matt's going to go over that. And Matt will also talk about how to select the right 529 plan for your family. And then I'll talk about how 529 plans affect need-based federal financial aid and some tips for grandparents. And I'll also talk about the best way to withdraw from your 529 when it's time to pay for college. And in today's presentation, we also have some tax filing tips, and then there's going to be a special segment on Upromise. So joining me today is Matt Toner from GradVisor and Julia McMillan from Upromise. Anytime during the presentation, if you have a question, you can type it into the question box on your control panel. And we'll do our best to answer all of your questions, but of course we only have an hour, so if your question doesn't get answered, please feel free to visit our forum, and that's at forum.savingforcollege.com. We'll also be sending an email with a link to the recording of the presentation after we're finished, and there'll also be a chance for you to give us feedback, so we really appreciate your feedback and letting us know how we did. So let's start, go ahead and get started by talking about the different options that you all have to save for college. According to Sallie Mae's 2018 How America Saves for College report, 22% of families said they were saving for college in a regular savings account. A regular savings account is not a terrible thing. I guess it's better than your mattress, but of course it has very low interest rates and no tax benefits. So then 14% of parents were using a mutual fund or other investment account. And of course, that's better than a savings account, but most of these investment accounts are taxable. So this table here is going to take a look at some tax advantage accounts that families can use to save for education. So you've got the 529 plan, the Coverdell Education Savings Account, your Roth IRA, and then custodial accounts under UGMA and UTMA. And the differentiating factors here that I've listed, first, are you able to change the beneficiary? So what's really important is that with a 529 plan, you are able to change the beneficiary to another qualifying family member, such as a sibling or niece or nephew, if the beneficiary decides not to go to college, or maybe you have leftover funds in the account. So that's definitely an advantage of 529s over the other vehicles. And then also 529 plans, as you can see, they're a bit, they're less restrictive as far as income limits and contribution limits. If you do decide to save in a Coverdell Education Savings Account, you can only contribute $2,000 per year per beneficiary, and you can only make those contributions if you fall within certain income limits. Same with a Roth IRA. You're limited to $6,000 per year in 2019, $7,000 if you're over 50. But again, not everyone is eligible for Roth IRAs. You have to fall within certain income limits. 529 plans, on the other hand, allow you to contribute a lot more. There is no annual contribution limit. They have what's called aggregate contribution limits that are determined by states, and these can be very high. The highest is California, which is $529,000, and these limits are determined by the approximate cost of education in that state. So as you can see, when you're deciding how you want to save for college, these are all good options, but 529 plans stand out among the rest for certain reasons. Thinking about your investments. So one thing about the 529 plan is they don't offer self-directed investments. So you are limited to what the program offers, but the good thing is the 529 portfolios, they're managed by investment professionals whose main objective is to maximize your college savings. So they're going to offer specific investment portfolios designed to save for college. Some are based on the child's age. So they're going to manage those investments and shift allocations to get you to reach your college savings goal. 529 plans, a couple other things. They also offer state income tax benefits, which Matt will talk about later, and also they allow gift contributions. So grandparents, aunts, uncles, anyone, friends can make a deposit to a child's account for holiday gifts, birthday gifts, for any reason. So that's another great benefit. Couple other differences between your college savings options is how you can spend the money. So with the majority of these savings vehicles, in order to get those great tax benefits, you have to use the funds on what's considered qualified education expenses. With a 529 plan, that's going to be for college or some K through 12 expenses now. So at eligible colleges, this includes tuition, fees, books, computers, room and board if the student's enrolled at least half-time. It could even be an off-campus apartment. Or for K through 12, you can spend up to $10,000 per year tax-free for tuition at private, public, or religious elementary, middle, and high schools. But you want to keep in mind that this is tuition only. Unlike the college expenses where you can spend it on a bunch of things, for K through 12, it's only for that tuition cost, and it's $10,000 per year per beneficiary, and that does not include preschool. I know we get that question a lot. A lot of people want to use their 529 to pay for those expensive preschools, but unfortunately, it's only K through 12. Compare that to the Coverdell, where although you can only spend $2,000, or I'm sorry, contribute $2,000 per year per beneficiary, you can spend that money on what's called qualified elementary and secondary expenses according to the IRS, which includes not only tuition, but books, supplies and equipment, academic tutoring, and sometimes even room and board, uniforms, or transportation. Finally, the UGMA accounts, they might sound attractive because they have no restrictions. The beneficiary can use that money for whatever they choose. However, remember that in most cases, when that beneficiary reaches legal age, they can use the money for whatever they want. So they might decide to not use it for college, which that you want to take that into consideration as well. We had a question before the registration from Randy, who asked, what options do you have when you withdraw? Can you use it for, can you use the 529 plan funds for trade school, community college, or certificate training? Randy, in most cases, the answer is yes. There are many trade schools and community college that are considered eligible institutions. And if you want to know for sure about a specific school or program, you can visit savingforcollege.com, and we have a tool that's find out if your school is eligible, where you can type in the name of your school and it will let you know whether or not it is.
Katie, we also had some questions coming in here, that I think we can answer now. So Lori's asking, does the student need to attend in-state college to use their 529 funds?
That's a great question. And in most cases with a 529 savings plan, you can use the funds toward any eligible college. The only time where you might have to use that, attend that in-state school, is if you're using one of the prepaid 529 plans, which, Matt, I think you'll also talk about a little bit more later. But for the most part, no, you do not have to attend the in-state school. You can attend a private school, public school, as I mentioned, community college, any program that's considered eligible.
Okay, great.
Okay, just one last question in this section. Can 529 plans be used for college entrance exams and other preparatory activities? Unfortunately, only tuition, fees, books, supplies, and equipment that are related to enrollment or attendance at an eligible institution are considered qualified. So these fees that are paid prior to the student's acceptance for admission are going to be considered a non-qualified expense. And you're probably wondering, what happens if I use the 529 plan for something else or a non-qualified expense? Well, what happens is that you're going to be subject to income tax and a 10% penalty on the earnings portion of your withdrawal. So if there's no other questions related to that, I'm going to hand it over to Matt, who's going to talk more about 529 plans and how they work.
All right, I think we can just go to the next slide here, Katie. All right, so what we're going to do now is we're going to go ahead and take a look at 529 plans from a high-level view, what they are, how they work, what kinds are available for you to invest in, et cetera, et cetera. So on to the next slide here, about what is a 529 plan. So essentially, a 529 plan is a tax advantage education saving vehicle. The government created these essentially to help families set aside funds for future college costs. And as Katie mentioned, as of last year, you can now use that to pay for K through 12 tuition. So the way they work is kind of the opposite of a 401k and much more similar to a Roth IRA. And what I mean by that is that post-tax dollars are going to go into these accounts. The earnings in that account will grow tax deferred and then are eventually tax free when used to pay for these qualified higher education expenses that Katie went over and the K through 12 tuition. So Greg had asked before the webinar, are there any advantages to using a 529 plan over simply investing in the stock market? Well, this is one of the huge advantages, Greg, of using a 529 plan, because you're essentially removing any capital gains from the equation or any other kind of tax considerations if you were to invest in a different type of account. So there's over 90 different 529 plans across the country. And you as an investor are able to invest in any one of them except for a few restrictions where it's restricted to state residents. Those are usually prepaid plans and a plan like the South Carolina 529 plan where only South Carolina residents can open it. But in general, you can open up any of these 529 plans. And all of them are going to be different. So what I mean by that is they're going to have different investment options. They're going to have different historical performance across the board. They're going to have different fees. So it's really important to kind of find the best 529 plan depending on a few different things. And I'll get into that in a little bit. So they're run by the state. So every single state except for the state of Wyoming has at least one 529 plan. And as Katie mentioned earlier, the state will usually partner with an outside financial institution to run this plan. So those are going to be the Fidelities, Vanguards, BlackRock's, T. Rowe Prices of the world. So when you're actually investing your money, you're investing it through their different investment lineups that they work with the state to kind of curate the different investment options that are open to you. So, but at the end of the day, when you open up a certain plan, you may be actually investing within Fidelity funds or Vanguard funds, et cetera. So if you do have a preference in the type of program manager, that's something to keep an eye out for. But let's go ahead and get to the next slide here where we're going to talk about different 529 plan benefits. So I had already alluded to all of these great tax benefits from a federal perspective. So you're not going to be paying any kind of capital gains or any other type of taxes when you're using these funds for higher education expenses and K through 12 tuition. However, over 30 states offer an additional tax incentive for opening up a 529 plan and contributing to it. So I believe 35 states, including the District of Columbia, also offer certain state tax deductions or credits on your contributions into those plans. But it does get a little bit tricky, and that's something I'll cover in a little bit more in detail as well. So next is crowdfunding, which is a great aspect of 529 plans. So these aren't like a 401k where you're the only one or possibly your employer that can contribute to these accounts. Anyone and everyone can contribute to these 529 accounts, grandma, grandpa, friends, family, etc. And many of these plans these days do have kind of online portals where you can send out maybe special codes to friends and family where they can go ahead and contribute electronically right to your account. So I believe Sally Mae said in the last study about 5 to 10% of contributions into 529 plans come from friends and family. So keep that in mind for your next birthday or holiday, graduation, etc. And perhaps in lieu of traditional gift, you can ask someone to contribute directly to your child's 529 plan. Next is flexibility. A lot of people get worried about, oh my God, what if I open up the wrong plan or wrong investment option, et cetera. Not something to worry about. These are pretty flexible investment vehicles. So one, you can change the 529 plan that you're in once every rolling 12 months. So if you open it up in July, next July, you can completely switch your 529 plan. Perhaps if you move or you don't want to be in that plan anymore, you can switch your plan. You can also switch your investment option twice a calendar year. So perhaps if you're a little bit savvy of an investor and you see something happening in the market you don't like or something you take an opportunity of. You can change your investment option twice a year. One question that I also get a lot is, what if my kid doesn't go to school or they get a scholarship, etc.? Well, if you get a scholarship, you can remove the amount of the scholarship from your 529 plan without any penalty. So it's not really something to worry about. If they don't go to school and you have 529 plan money sitting in there, you have a few different options. So one, you can rename the beneficiary. So if you have another child, if you have a niece or nephew, if you want to rename yourself the beneficiary and go back to school, that's something you can do without any tax consequences. Also, there's no kind of time limit for using the money in there. So, sometimes people just kind of leave that 529 account there to grow and then eventually perhaps use it for future grandchildren for their education in the future. However, if you just have money sitting in there and you have no other reason for it to be in there, as Katie said earlier, you can remove the money. It's just known as a non-qualified withdrawal, which means that just the earnings portion, never your contributions or your principal amount, just the earnings portion is going to be subject to income taxes and a 10% penalty. This is very similar to removing money from a Roth IRA before you're 59 and a half. So we had a few questions on this matter. So Elaine had asked before the webinar, can I switch or transfer a plan that was set up with an advisor to a direct sold plan to avoid advisor fees? So something we'll get into in a little bit. There's two different types of 529 plans. There's advisor sold, which you have to go through an advisor, but they usually carry with them more fees and sometimes sales charges, or direct sold 529 plans that you can open up yourself that may come with lower fees and a limited investment option menu. But absolutely, but as I said, as long as that plan has been opened up a year, you can go ahead and switch over that plan to a direct sold plan. But if you are in an advisor sold plan, definitely check, because sometimes there are things such as surrender charges, or you may be subject to another type of fee for not having that investment open that long. So definitely check with an advisor before you go ahead and do something like that. And then Eric asked, for multiple kids with separate 529 accounts, is it possible to use funds from a sibling's 529 account? And the answer here is absolutely. Once again, you can, as I said, rename the whole beneficiary and transfer that entire account. Or let's say you have an extra $5,000 or $10,000 in an account, and you want to switch that over from the middle child to the oldest child, or vice versa. That's something that you can easily do as well, as long as they're a qualified family member, which is a very wide net. Moving on, no income restrictions. So it doesn't matter how much or how little you make. There's no any kind of income phase outs or anything. Everyone's eligible to open up a 529 plan. Next, minimal financial aid impact. I won't get into this too much because it's something Katie will cover more in depth. But just know that 529 plans get favorable treatment when filling out that FAFSA form. So don't really let that scare you away, that if I'm going to be saving in this, I'm going to get less money down the line. Katie will go into more detail on how that all is going to work. And lastly, high contribution limits. So if you do have aspirations for your child to perhaps go get a graduate degree, law school, medical school, etc., in most cases, you can contribute over $400,000 to a 529 plan. So don't worry that you're not going to be able to be saving enough in a 529 plan. So Prakash asked before the webinar, is there a limit to the amount we can deposit when we contribute to a 529 plan? Well, so the answer to this is that there's no really quote unquote limit besides that 400,000-ish number that I had mentioned. However, to avoid any kind of tax consequences, you're limited to your annual gift tax exclusion, which is currently $15,000 for individuals and $30,000 for married filing jointly. One cool thing that 529 plans allow you to do is to quote unquote super fund the plan. So that means that you can choose to do up to 5 years of gifts at once, which brings that amount to $75,000 or $150,000 for joint filers if you want to make a one-time contribution to the plan. So any amount above these amounts is just going to reduce your lifetime gift tax exemption, which I believe is around $11.4 million now. So on to the next slide here. Janae had asked before the webinar, what age is the best for your, to start saving for your child's education? And my answer is usually the earlier the better, but it's never too late. So obviously we've all heard compound interest is your best friend. So you can see that there is tremendous upside to getting started earlier. And just a reminder, your child doesn't even have to be born yet to start saving. You can simply name yourself as the beneficiary, and then when your child has a social security number, you can go ahead and roll over that beneficiary to your child if you want to get a jump start. But you can see here, even just putting in $200 a month, the difference between having it in there 12 or 18 years could be over $40,000. So always get started earlier. But you know what? You're always going to get the question, is it too late to start a 529 plan? Well, the answer is that it's never too late. There's just some situations where it may be more advantageous for you. So, for example, if you live in one of those states that's offering you an extra state tax deduction or credit, go ahead and get a 529 plan started. Take advantage of that deduction or credit. Everybody likes to, write those off when it comes time for tax season. And then in addition, if you are getting started late, some plans do offer FDIC insured or certificate of deposit type of investments, which essentially kind of guarantees your principal. There may not be as much upside, but you're not going to be losing out on that principal. And usually the longer you leave it in there, 1, 2, or 3 years, the more return you can get. So if you are getting started, or if you're a conservative investor, or maybe a grandparent saving for a child, an FDIC insured or a certificate of deposit investment type may be the way for you to go. But enough about the high level. Let's go on here and let's talk about how am I going to select this 529 plan. If there are over 90 of them from across the country, which one of these should I be opening? How do I go about selecting that right 529 plan? Because it is important that you're matching up to the right plan and investment portfolio for you. So we'll go through the step-by-step process here of how to really think about that. So moving on, the first thing that we're going to have to really decide is that the 529 world is split at a high level between two different types of accounts. And you may have heard both of them. So the first is going to be prepaid accounts. So prepaid is offered by a dozen or so different states, and the pitch is essentially lock in tomorrow's tuition at today's rate. Well, that's not exactly true. You're always going to be paying a slightly inflated rate, a little bit of premium on today's prices, but it is a more quote unquote guaranteed type of option and a viable solution for a lot of parents. If your state doesn't offer a prepaid 529 plan, you can always invest in the private tuition 529 plan, which operates the same way as all the other ones, but it does have about 300 of our nation's top schools under our umbrella. So you can invest in the private tuition 529 plan and use it at those institutions. One question you're always going to hear, though, is if I open up this account, and this is what Lisa had asked, how are prepaid savings valued if a student goes to a college out of state? So, if you live in Florida, you open up the Florida prepaid plan and your child, for example, goes to school out in California or Texas. How does that work? So each prepaid plan is going to be a little bit different. And you really want to read the master contract in order to know exactly how it's going to work. But in most cases, they will pay out an amount equal to the weighted average tuition and contractually specified fees at your state's public institution, not to ever exceed the actual tuition and fees you're going to incur. So what that means is that you're going to have a little bit of uncertainty when you're investing in these types of plans. Depending on the type of college your kid's going to go to school, you may have saved way too much because they're going to a cheaper school, or you may have saved too little because now the institution that they're going to is much more expensive than your in-state tuitions. And we'll go over a little bit in the trade-offs in a second. Next is going to... Oh, yeah, go ahead.
Sorry to interrupt, but we have a really great question from Keith. Can a beneficiary have both a prepaid plan and a traditional 529?
Absolutely. So there's definitely cases where, and even some of the prepaid plans aren't going to cover certain types of things. So some prepaid plans are just for tuition, meaning that fees, books, room and board, stuff like that isn't covered underneath the contract. So it definitely may be the case where it's prudent to go ahead and open up both a prepaid plan and then to supplement that with a traditional 529 savings plan that we'll get into what those are here in a second. And we'll just roll right into it here. So the 529 savings plan is what most people think of when they hear 529 plan. So this is where you're putting post-tax dollars in, your money is invested into the stock market depending on the investment option you pick, and then your account goes up and down as that investment does. But as I said earlier, these savings plans are broken into two different types, and that's broker sold and direct sold. So direct sold, as I said, you can go ahead and just open up yourself. You can go to the New York 529 plan website or the Utah 529 plan website and go ahead and open it up yourself right then and there. An advisor sold plan, you're going to need a financial advisor in order to open. On average, these plans usually have higher fees, but much more investment options to choose from. So Dejan had asked, does it ever make sense to go with an advisor sold plan? Well, if you're simply going to choose an age-based type of investment option, which is what the majority of parents do, I really wouldn't suggest it because those are pretty standard. However, if you're a more savvy investor and you would like to build a certain type of portfolio, maybe choose between small, mid-cap, large-cap type of stocks, socially responsible investing, more international type of funds, then I would suggest looking at an advisor sold plan because they are going to have a larger investment menu for you to choose from. So let's address Allison's questions here. What are the advantages to prepaid versus traditional 529 savings plans? Well, I think, Katie, I think we can agree that this can be a whole separate webinar in itself, but here's a few things to consider. The prepaid is a safer, more guaranteed type of option. However, it might not be affordable for all families. So depending on the age of your child and what state you're in, how much schools are costing, a contract might start out at something, for example, of $300 a month, depending on the age of your child. But with the savings plans, most of the time you can get started for as little as $25. So it's just not always financially feasible for some families looking to get started. Also, that prepaid cost is going to be tied to your state's institutions. So for example, I live in Florida where we have the Florida prepaid plan. It's amazing. The Florida schools are great here, but the thing is that compared to nationally, they're super cheap, especially if you're in-state residents. So if I were to open up a Florida prepaid plan and then my child were, for example, to get into something like Harvard or Yale, a private institution, I'm going to be well short of my savings goal. So once again, something like Katie asked earlier, it does make sense sometimes to go ahead and open up a prepaid plan and then to supplement it with a 529 savings type of plan. So on to the next thing we really need to think about here is going to be checking your state's tax incentives, which I mentioned earlier, over 30 states offering some sort of tax deduction or credit. You can see from the map here about how much that would be worth if you're making $100,000 in household income and contributing $100 a month to 2 different plans. This is how much extra you would get in your pocket at the end of the day. However, it's not super simple. So in certain states, very straightforward, you have to open up your state's 529 plan in order to get that tax deduction. So in Illinois, for example, up to a $20,000 state tax deduction, you have to open up and contribute to the Illinois plan in order to get that. New York, same thing, you have to open up the New York 529 plan. But there are certain things called tax parity states, and those are going to be Arizona, Arkansas, Kansas, Minnesota, Missouri, Montana, and Pennsylvania. What this means is that you can open up any 529 plan from across the country and still get that state tax deduction. So you can live in Pennsylvania, open up the California plan or the New York plan, and still get that state tax deduction. But one also thing to be wary of is that sometimes these kind of state tax deductions are essentially wiped out by a plan's high fees. So keep that in mind. If you are opening up your state's plan, do take a look at those fees, because if they are 5 or 6 times as much as investing in an out-of-state plan with super low fees somewhere else, it may not make sense to even take that state tax deduction. So something to be aware of. All right, on to the next thing here, research and compare. So there's a few things you want to look at when you're considering different 529 plans. First is going to be, as I mentioned earlier, the plan manager. Are they well known? Have they been around for a while? Do you live in a state with no state tax deduction and perhaps you just want to use Fidelity because you have your 401k with them already and it will all be in one place? You know, the last thing you want to do is really wake up one day with a whole new investment option menu and a whole new set of fees. So, you know, keep an eye out for a well-known type of program. Next, a pretty obvious one here is going to be fees. No reason to pay a lot if you don't have to. Obviously, the lower the fees, the more money that's going to be in your account at the end of the day. So they can vary very widely, so keep an eye out. One plan can have over 10 times as high of fees as another plan. So definitely something to keep a lookout for when you're opening up your plan. Next is going to be investment options. Do you have a wide range of investment options to choose from? If you're a conservative investor or you're getting started late, do they have that FDIC insured or certificate of deposit type of investment option for me? You know, how risky? Do they offer a complete risk, you know, portfolio? If you're a super aggressive investor, you want aggressive investments. If you're a conservative investor, you want conservative investments. Are they giving you that kind of full breadth of choice? And then lastly, one thing we want to look out for is going to be performance. Another pretty obvious one, better returns means more money. So keep an eye out on how the plan and investment portfolios have performed over the years. And then this is something that you can research right on savingforcollege.com. We have this great thing called a 5-cap rating system where we kind of take into account all these things that we've talked about and give it a rating. And then we also have a great comparison tool. So if maybe you're in between your state's plan and 2 other different types of plans and you want to compare them across the board, you can do that right on savingforcollege.com as well.
Okay, Matt, we have a question regarding investment options. Jason asked, are more states offering ETFs as an investment option, either standalone or in conjunction with mutual funds, or are they still principally using mutual funds?
So that's a great question. 529 plans have grown the type of investment options that they are offering. So you are still going to have traditionally those mutual funds in there, but you're also going to have, ETF type of passive investing. You can also find actively managed funds if that's something that you believe in. There's socially responsible investing funds. Once again, if this is something that you're super concerned about, the type of funds being offered, maybe do look at an advisor type of plan. In addition, on that comparison tool, one of the things you compare is number of investment options offered by the plan on savingforcollege.com. So if you are looking for something with a lot of investment options, you can compare that right on savingforcollege.com once again. To go ahead and seamlessly talk about that investment options, let's go to the next slide here and talk about selecting one of these investment options. So at the top, these are the type of things you want to consider. Am I going to get an age-based, static, or FDIC type of portfolio? What are the fees associated with that investment option? What is my risk tolerance, and how do I match that up with the type of portfolio that I'm selecting? And then what is my investment horizon? How long is it going to be until my child gets to college, or how long is it going to be until I'm going to tap this account? You shouldn't be invested the same way if your child's a newborn as if they are 16. So that's something to consider as well. So to talk about the different types of investment options, the first one is going to be a static investment portfolio. So this means that this portfolio is going to have a specific investment objective, and the asset allocation is not going to change over time. So if your portfolio is 75% equities and 25% bonds, when you open it up, in 10 years from now, it's going to be 75% equities and 25% bonds. This will not change no matter how close your child gets to college. And as we just talked about, you should be getting more conservative over time as your child gets closer to college. So if that's something you want to kind of set it and forget it, look towards age-based investment options. So these automatically become more conservative as your child gets closer to college. Your portfolio may be 100% invested in equities when he or she is a newborn. And then by the time they get ready to fill out their college applications, you may be in, let's say, 10% in equities to kind of minimize your downside risk in case something were to happen to the market. So if this is something that you really just want to go ahead and choose, set it and forget it, it will automatically change over time. And lastly, FDIC insured or certificates of deposits that we were mentioned earlier. These are investment options that guarantee you a rate of return for a certain period of time, usually 1, 3, 5 years. And it is a more conservative option, which means you're limiting your upside, but in most cases, there's no risk of losing your principal portion. So your contributions that go in, there's no really risk of losing that amount. So as I said, great for people saving for K through 12, grandparents, anyone who consider themselves a conservative investor. But as I said, Ruth asks, are all 529 plans FDIC insured? Not all of them. Once again, another thing that you can find on our comparison tool, do they offer FDIC insured type of investment option? Not all plans are going to have them. Some of them will. So if that's something you're interested in, make sure you're investing in a plan that has this option available.
Okay, Matt, we have a couple of questions regarding investment options for people that want to save for K through 12. And I know you mentioned that FDIC insured products might be a good option. But what if someone is already invested in the age base based on when they started the 529 for college?
Yeah, so what you might want to do there is, one, these plans haven't caught up yet in most cases to this K through 12 thing that was dropped last year. So these age-based options almost all the time are going to be tied to when your child goes to college. So it could definitely be the case where you may want to select another investment option to start allocating funds to that you're specifically going to be using for K through 12 tuition to kind of match up with that shorter investment horizon. I do think that in the near future, we may have different age-based investment options for people perhaps saving for private elementary or private high school type of investment products, but we're just not really seeing that yet. But I do think that we'll see them soon.
Okay.
All right, awesome. So I think I'm going to hand it back over to Katie here, who's going to go over some of the financial aid aspects and FAFSA and how you do all that. So you may want to stick around for that if this is something that you're interested in.
Okay, thanks, Matt. For those of you who have a child that is nearing college age, you might be wondering, if I have money saved in a 529 plan, does that mean my child's going to get less financial aid? And I'll do my best over the next few minutes to hopefully shed some light on that question. Just to clarify, though, right now we're going to be talking about federal need-based financial aid. There are other types of financial aid available, institutional student aid, and that's going to vary by college. And I know someone had asked about 529s and the CSS profile. We're not going to touch on that in this presentation because that does vary by school. So everything that we're talking about relates to federal aid and the FAFSA. So the amount of financial aid your child receives is going to depend on your expected family contribution, and that's your EFC. And this is the amount that the college expects you to be able to pay out of pocket. So the higher your EFC, the less financial aid you're going to get because the college assumes you don't need as much financial aid. So the formula to calculate this EFC number uses information that you've entered on the pre-application for federal student aid, which is also known as the FAFSA. And this includes income and assets of the parent and the student. And as you can see from the slide, the student's income and assets are going to have the greatest impact on financial aid. So you want to limit the amount of student assets if you're trying to increase your financial aid generally. So the good news is 529 plans receive what's called favorable treatment on the FAFSA. And what that means is a 529 plan account, whether it's owned by a parent or a dependent student, is going to be considered a parent asset. And so what that means is with parent assets, so the first $20,000 or so that you have in savings, besides retirement savings, is going to fall under what's called the asset protection allowance. And this will not be counted towards your EFC. The exact amount depends on the parent's age, but generally it's around $20,000. So any amount above this $20,000 is only counted at a maximum of 5.64% of the 529 plan account value. So that means if you have $10,000 above the allowance, it's only going to reduce financial aid by $564 at most. You might be thinking, well, hey, I don't want to reduce my child's financial aid by $564. Well, when you compare this to other student assets, such as an UGMA account, that is counted as a student asset, and that counts as 20%. So 20% of the value of that type of savings vehicle is going to count against your financial aid. So as you can see, the 529 actually has a big advantage. But the biggest financial aid advantage of using a 529 is, instead of another savings vehicle, is that nothing has to be reported on the FAFSA when the funds are withdrawn to pay for college. So, and this is in the case of a parent-owned 529 plan. So when a parent takes money out of the 529 plan to pay for college, nothing is reported as income on the FAFSA, and then that's pretty huge. Unfortunately, in the case of a grandparent-owned, or if another person owns the 529 plan, they are going to count that as income on the child's FAFSA. So we'll talk about that on the next slide. We often receive questions, I'm sure we will again today, are these plans available for grandchildren? And if so, how does it affect financial aid? And a lot of times people ask, well, for grandparents, is it better for us or for the grandchild to own the account, or someone else? So the great thing about 529 plans, is Matt and I both touched on, is that anyone can contribute to the child's existing plan. So it makes a great gift for holidays and birthdays or whatever. So grandparents have the choice of investing in the child's existing plan that's owned by a parent, or they can open up their own account and make the child a beneficiary. And that, again, that's not just grandparents, that's aunts, uncles, friends, relatives, anyone. So first we'll talk about the benefits of having the 529 in the grandparent's name. The grandparent's going to retain control of the account, and they can take the money back if needed. So at any time while the grandparent is saving money, if they, feel for whatever reason, maybe they need the money for a medical emergency, maybe they, had a falling out with the child, whatever the reason, the grandparent can always take that money back. Again, they can change it to another beneficiary, or they can take a non-qualified withdrawal and just pay that 10% penalty and income tax on the earnings. Another benefit for the grandparent may be that they might get a state income tax deduction depending on where they live. So as Matt mentioned, over 30 states offer a state tax deduction or credit for the 529 plan contributions. Most of the states will allow anyone who contributes to claim the income tax deduction or credit, but there are 10 states that limit this benefit to the account owner. So if a grandparent lives in one of these 10 states where they can only get their state tax benefits if they're the owner of the 529 plan, that might be an incentive for them to open up their own account. For example, I think Matt mentioned in New York, contributions up to $5,000 to the New York plan, or $10,000 if you're married, are deductible from state income tax, but only if the account owner or their spouse, only for the account owner or their spouse are eligible to claim the deduction. Then the third benefit to having the 529 in the grandparent's name is that the assets held in a grandparent-owned 529 do not have to be reported on the FAFSA, but that's only as long as they stay in the account. So the drawback to holding it in a 529 owned by the grandparent is when the grandparent goes to take that withdrawal. So what happens is the amount of the withdrawal is going to be reported as student income on the FAFSA, and it's going to be counted up to 50%. So that means if a grandparent wanted to give $10,000 to help a grandchild pay for college with money from the grandparent-owned 529, it could reduce the grandchild's financial aid by as much as $5,000, so half of the value. So I don't think that anyone wants to do that. At Saving for College, we have a couple workarounds that we suggest to avoid this from happening. If you do have money in a grandparent-owned account, you can wait for until January 1st of the grandchild's sophomore year of college to pay his tuition. This only works if the grandchild is graduating in 4 years, since the FAFSA looks at income from 2 years prior. So if your grandchild is graduating in 5 years, you can take your distribution after January 1st of the student's junior year. And then, so after that, you should be in the clear to start taking distributions that will not affect financial aid. Another option is to roll the money from the grandparent's 529 to the parent's 529, 1 year's worth of tuition at a time. You can wait until after the FAFSA is filed to transfer the funds from the grandparent 529 to the parent 529 so that it won't be reported as an asset on the FAFSA. You just have to be sure to spend the money on tuition before the next year's FAFSA comes around. So if you're going to do this, be sure to open the parent 529 in the same state as the grandparent 529, as some states do have recapture rules if you're going to roll the funds over to a different plan where you might have to give back any state income tax benefits that you claimed. So, just to recap, in most cases, it's probably best to keep the plan in the parent's name unless you have some specific personal reasons. But I'll just go over a few important points. So withdrawal from a 529 plan owned by a parent or dependent student will have the least impact on financial aid eligibility. So as we mentioned, $10,000 in a plan owned by a dependent student or their parent will reduce aid eligibility by as much as $564. So compare that to $10,000 in a 529 plan owned by an independent student or in some other type of account that counts as student income is going to reduce eligibility by as much as $2,000. But then a $10,000 distribution, so when that $10,000 is taken out of a grandparent 529 plan to pay for college, that's going to reduce aid eligibility by as much as $5,000. So those are some important tips to keep in mind. Matt, did we have any questions on that? Okay, moving on to 529 plan withdrawals. So as we mentioned, if you do take a non-qualified 529 plan withdrawal, you can get stuck paying a penalty and income tax on the earnings portion. So how do we avoid this? First, you want to calculate the amount to withdraw that can be tax-free. So you add up all your qualified education expenses, and don't forget to include up to $10,000 in K through 12 tuition per beneficiary. And then you're going to subtract any tax-free educational assistance that you want to track the expenses that was used to generate either the American Opportunity Tax Credit or the Lifetime Learning Credit. You can take advantage of both of these, both the American Opportunity Tax Credit or the Lifetime Learning Credit while you're using your 529. You just can't double dip. So you want to make sure you take out anything used to generate those credits before you add up your 529 expenses. Jennifer had asked, what happens to the money saved in a 529 if your child gets a scholarship? And someone else asked, what happens if they go to military school? So if you have leftover funds because the student got a scholarship, you want to withdraw the amount of the tax-free scholarship, and that will be without penalty. However, the earnings portion of the distribution will be taxed as ordinary income. So basically, your tax-free benefit now becomes a taxable investment, and the penalty will be waived. And that's for a scholarship or if the child gets accepted to a U.S. military academy. If you want to avoid paying taxes altogether, consider changing the beneficiary to another family member who will use the funds. They can use it for college or now up to $10,000 in K through 12 tuition. Or you can keep the money in the 529 to use for the student's graduate school. How to withdraw the money. So a lot of people ask, what's the best way to withdraw the funds? Do we get the money sent to ourselves? Do we send it to the school? We recommend that you have the distribution payable to the beneficiary. That way, if there's any non-qualified withdrawals, they're going to be taxed at that beneficiary's presumably lower tax rate. And also remember that withdrawals must match up to the amount of qualified expenses that you incurred during the same year. So just remember in December, you don't want to take a 529 plan withdrawal in December to pay spring tuition for the next year. You want to make sure that those qualified expenses match up with expenses paid with the withdrawal in the same year. Moving on to the next slide, so I want to give leave time for Upromise. Right now it's tax season, so we want to offer a couple tips for you regarding 529 plans in your tax return. Do you need to do anything? You need to report your taxable distributions, and in most cases they will not be taxable, but if your distribution amount exceeds the beneficiary's qualified expenses, you need to report these as other income. So remember, K through 12 tuition must be less than or equal to $10,000. Anything above will have to be reported. Transportation costs are not qualified expenses. Room and board is a qualified expense only if the student is enrolled at least half-time. And you can also remember that the basis portion of your 529 will never be taxed or penalized because this is the amount that you already contributed with after-tax money. You also want to report 529 plan contributions that are greater than $15,000. This $15,000 is the amount of the annual gift tax exclusion. So in 2019, you could make gifts, including 529 plan gifts, up to $15,000 without affecting gift taxes. Gifts above this limit will have to be reported on Form 709 when you file your taxes. However, 529s offer another great benefit where you can actually make gifts between $15,000 and $75,000 if you treat the contribution as if it were made over a 5-year period. So I think Matt touched on this earlier, but if you are going to take advantage of this 5-year gift tax averaging, you will have to report this on Form 709. And remember that the gift tax exclusion includes all gifts, not just 529s. So anything above the annual exclusion amount will be counted against your lifetime limit, which is $11.4 million in 2019. So most people can make very large contributions without having to pay any sort of gift tax. Another thing to consider right now is you might want to use part of your tax refund to fund your 529 plan. Certain states actually allow you to make direct deposits from your tax refund to their 529 plan. I know for sure that California offers this, and so does Colorado. You can check with your plan to see what options are available to you. But that's an easy way to get that tax refund money and start growing it for college. And then also your federal tax refund, the IRS allows direct deposits for income tax refunds for up to 3 different accounts. So maybe consider, maybe one of those accounts might be going towards your vacation with your family, but maybe also consider allocating some towards your 529 plan. And if there's no other questions, I'd like to move on here and quickly introduce Julia McMillan, who is Senior Vice President of Business Development for Upromise, where she's responsible for revenue, marketing, and product management. We think Upromise is a great complement to 529 plans. It's a free program that lets you earn extra money for college when you shop and dine out. And by linking a 529 plan to a Upromise account, parents and grandparents earn bonus rewards to boost their savings and reach their goals faster. So it's really a great program. We're excited to have Julia with us today to tell you more.
Great. Thanks, Katie. Thanks, Matt. And thank you to all on the call for joining us. So we all have a common theme together between all of us on the call, in that we want to help our children, our grandchildren, our families be able to save for college. And we have aspirations for our children and our grandchildren. We want the best opportunities for them, and higher education and college is part of that. However, at Upromise, and I'm sure that all of you on the phone also would probably agree, we know that saving for college isn't necessarily the easiest thing. There's multiple priorities that occur within a family, whether it's family bills, home, daycare, things along those lines. But we do know that it is doable. So Upromise helps families save for college. This is our sole commitment to you. And we've been helping families save for college for almost 20 years. As the college landscape changes, we want to help you navigate these changes. So how do we do that? Well, we do it with access to expert advice, simple saving tools, and unique savings offers that can help you accelerate and grow your college savings every day. So how do you do that then? With a free Upromise account, as Katie mentioned, it is free to join. You can access savings information, as well as access easy ways to save every day by doing the things that you do every day. And this includes shopping, this includes dining, and making purchases on a Upromise MasterCard. We firmly believe that a little savings each month can add up over time. And as you saw from that graph that was shown earlier, even if it's $25, $50 over a period of time, a little bit of savings by the things that you do every day can certainly help create those savings for college. You mind going to the next slide, Katie? Thanks. So Upromise provides members with a lot of flexibility. As we mentioned, it's free to join. And as you take advantage of college earning opportunities, you will see your college savings grow. You can link it to any 529 college savings plan, and we're often asked, can I link it to more than one 529 college plan, or can I link my account to only one plan? And the answer is you can link it to as many 529 plans as you have. We want you to be able to put funds into those accounts and do it easily for you. So you can, as you start accumulating your savings, you don't have to have a 529 plan to join Upromise. You can also link your checking or savings account and then link your 529 once you're ready. So once you've done your research and determined which 529 is best for you. But it's easy to get started today. As your earnings grow over time and grow as you use and participate in the Upromise program, every month we'll transfer those savings or those earnings into your savings vehicle, the account that you designate, whether it's a 529 checking or savings account, and then you can have those funds and see those funds grow for college for your child. And again, it's not just for parents, just like a 529 plan, grandparents, other relatives, aunts, uncles can also participate in Upromise and link their Upromise account to your 529 plan. We know that saving for college certainly is not easy, and we want to be able to help you. But joining Upromise is easy, and we are able to help you start today. So if you'd consider it, that would be fantastic. It's just go visit the website at upromise.com. Katie, I'm going to turn it back over to you to wrap us up.
Okay, thanks so much, Julia. As Julia mentioned, Upromise is free. You can check out what they have to offer at upromise.com. And also I know we did our best to try to get through most of the questions. I apologize. I know there was a lot of great ones out there that we didn't get to, but please visit savingforcollege.com for more information. You can also visit our forum at forum.savingforcollege.com. And again, keep an eye out for an email with a recording to link to this presentation. And we'd appreciate if you share it with anyone who might find it helpful. Thanks again.